All right.
Okay, we're live.
Yep. Let's check on the attendees. So I still see Tatiana has now joined,
Okay, cool.
but I don't
Hi,
know.
Tatiana. Nice to see you. Well, I don't see you, but it's good to see you're interested. We always had some good conversations. Um, what we'll do is we can just kind of talk a little bit before people join in.
Mhm.
So first, I guess we'll just start by saying thank you, to everyone who joined. Um, Essentially, we'll get into it a little bit later about what kind of gave us the idea of doing this webinar, but um, just a lot of stuff's been happening, and there's been in the news with the war and the interest rates and all this stuff, inflation, it just keeps coming up. So we thought, hey, let's do a webinar. Let's try to share our thoughts on what's going on, because depending on whether people are looking to buy or sell or invest, whatever it is, this stuff is relevant. So here we are. Let's do a quick
Yep. So
update.
we got three. We got Tatiana, Chai or Chi, and
Okay.
Jeremy.
So, beautiful. All right. Well, good to see you guys. Let's go ahead and just get started then. We'll start on time and it'll be quick. I don't think we're going to be here for probably not even a half hour, but depending on how Q&A goes, you can stay longer. Do you want to go ahead and share the slides, Preston?
Yep.
All right. Okay, awesome. So again, thank you everyone for joining. We're excited. This is our first live webinar that we're doing like this. I've done one before for investments and stuff like that, but essentially what we're trying to do is just add value. What we're trying to do is just show people that, we have, there's data out there and there's intelligent decisions that you can make based on that data. And if we can help in any way, whether it's just tuning in or whether it's, actually talking and talking out your specific situation, we're here to do that. While more people go ahead and join in, we'll start just telling a little bit of an introduction, even though most of you guys probably do know who we are, but I'm Alex Escobar, and this is
Hey,
Preston.
I'm Preston Capers.
Yeah, Preston. So the two of us, we're on we have a real estate team called the Optimus Realty Group. We are within the brokerage of Samson Properties, and we're based in Kingstown, Virginia. We're licensed in DC, Maryland, and Virginia, and we're available to help with whatever it is you need in that area. Also, we are both active real estate investors, so we're doing this for ourselves, and we also love to help other investors. So that's another kind of angle that we take and perspective that we try to share with this information. We also have a podcast called Screw the Stock Market. And it's kind of a funny name, but really it's a podcast focused on investment and investment strategies that are outside of the traditional, 401k or stock market investments. A lot of it is focused on real estate, but we talk about other things too outside of real estate. So please feel free to tune into that. You can find it on anywhere you listen to podcasts. That's kind of a fun project that's going on. And then lastly, what I'll do is I'll put in the chat here. This is a new networking group that I'm starting with some other local real estate investors. It's called Alexandria Advanced Real Estate Networking Group. And so really it's just Alexandria Advanced, and it is a real estate networking group. So you can go ahead, click there and register for it. And we'll just talk about, and what the focus is really experience and action, right? Instead of covering, just fundamental basic things about how to analyze properties and stuff. The idea is more, you're in a room of experienced active investors that are essentially looking to help each other to grow and to do deals together. So feel free to sign up for that one. The first meeting is going to be on April 25th at 7 p.m. and it's going to be via Zoom, so you don't have to physically get dressed and come out, but it should be a really good value, and I'm excited about it. So again, why are we here today? So what we're really trying to do is just share our take, our perspective on what is happening in the real estate market today and discuss some of the different actions that we can take as people who are either homeowners, people who want to become homeowners, or investors, whatever that is. What's happening in the market affects us all. And so that's what we're going to talk about. And Preston?
Well, I mean, Alex, I think you've done a really good job of kind of like summing up what it is that we're going to talk about. And I kind of feel like you may have even touched a little bit on why it is that we're here today. Is there anything else you want to reiterate before we move forward?
No, I think, again, I think really the intent is just to share and to have a conversation and a dialogue. This just keeps coming up whenever we have these conversations with people. And so having the same conversation over and over again, we thought, hey, it's worth it to just have some sort of a webinar where we can share this a little bit more at scale with other people. And so, let's do it. Let's jump in.
Okay. I mean, so basically we're just offering our friendly advice to folks as real estate professionals, and anything that we're going to say during this show is just to be considered that, right? If you're considering acting on any of this information, we recommend that you discuss it first with a local professional. That way you can make sure you understand exactly what the implications are of any action that you take before you take it.
Yeah, that's a good kind of, disclaimer. As realtors, we're really only allowed to give real estate advice to our clients. And whether it's you talking to a financial advisor or a CPA or a local realtor, if you're in the DMV, we'd be happy to become your realtors. But at this point, we're just sharing kind of information for informational purposes. We can call it that. And so why don't we just go ahead and jump in and just get to it?
Okay. Sounds good to me, Alex. So let's talk about, why it is important for us to predict the future. Sounds like we should just go ahead and go straight into our first recommendation. What are your thoughts?
Yeah, let's do it.
All right. So I'll take the first recommendation, and that's going to be this first slide here. So for our homeowners, right? I think the main thing that we want to get you guys to go away with is if you already own your home and you're seeing values in the area drop, the best strategy then is for you to just stay there, period. All right. There's no need for you to sell your home in that case, because most times you're going to take a loss. And if you're looking for a home as your primary residence, then it's most important for you to think about the fact that you need to buy a home that A, you can afford, and then B, you like enough to stay in for long enough for you to actually gain some equity, so that when you do decide to sell, you can actually realize that equity and make some profit. There's a lot of uncertainty right now within the real estate market itself in general. And with higher interest rates, it's harder for people to afford the amount of home that they would have gotten just a few months ago. Additionally, you've got a lot of cash buyers out there in the market that were already out there before the rate hike went up. And now they're looking for more advantageous ask or deal to.
Preston, I'm not sure if it's on my end or not, but you're breaking up a little bit. What I'll do is I'll ask people in the chat to let me know if Preston's cutting off. I see some people saying that Preston's cut off. Hey, John. So am I still coming through clearly? Because if not, I'll just kind of take over for Preston. Can someone put in the chat if you can hear me? Preston says it's cutting out. He can't hear me either. Crap. We lost Preston. All right, well, the show must go on. I'll kind of re-emphasize the point and hope that it's coming through. This recommendation works whether you're a buyer or a current homeowner. Essentially, the goal is your number one strategy when you're buying your primary residence is to buy a place that you like enough that you can afford. So those two things, you can afford it and that you like it enough to stay there. Because if there is a downturn, which we don't know, but if there is one, your strategy is going to be to just stay in your house and keep making your payments. You might have to write it out 5 years, 10 years, who knows? But eventually we believe that home prices would rebound and come back around. So that's recommendation number one. We'll go on to the next one, which is recommendation number two. And this is another one that just keeps coming up over and over again when I deal with buyers who, it's a good thing that you have that kind of investment mindset. But a lot of people come to me and they say, Alex, I want a home that I love, and I want a home that's also going to be a great investment for me, because maybe later I'm going to want to rent it out. And that's good. You can do that. But the only problem is that by picking a home that's kind of good at both, you're not picking a home that's maximal for either, right? Usually your best primary residence is not the best investment for you. And so if you can go ahead and just, pick your primary residence as a home that you like, refer back to recommendation number one. It's a home that you like, and it's a home that you can afford. Boom. Then when it comes to investment properties, your criteria should be completely different. It shouldn't necessarily be a home that you would ever consider living in. You'd probably be better off picking a home that gives you great cash on cash return, great IRRs, great other things. And that's probably a better move for you strategically. And 9 times out of 10, it's not the same house. So, so that's recommendation number two. Let's see what else we got here. So recommendation number three, this one's a little bit controversial. I've had some conversations with people who are a lot more conservative, strategically, a lot of times. But my idea is essentially that, especially as an investor, but even as a primary homeowner, loans are good. Use loans to your advantage. It's a really powerful tool. And so for a bunch of different reasons, more than I'll even cover here, but the main two are essentially that by keeping your own money and kind of using the bank, using other people's money to either buy your primary residence or an investment, you're keeping some money liquid that will either give you an opportunity to make other investments with other things, or to at the very least buy more than you could buy with just your money. I know that for me and probably most of the buyers that I've worked with, they buy a loan because they have to, right? Because they don't have $500, $1 million in the bank ready to just deploy towards a house. But the other side of that is that even some of the wealthiest people in the world, look at these people. Hey, Preston's back. You back?
Sorry. Yeah.
Good stuff,
Can
man.
you guys hear me? Sorry,
Yeah,
I had
yeah.
to change chargers. Go ahead.
Okay, good stuff, man. Well, we move forward. We're on recommendation number 3 here, talking about why loans are such a valuable tool. And essentially the idea is that if people like Elon Musk and Warren Buffett and Mark Zuckerberg, who have more money, they have enough money to buy any home that they want and every home that they want in cash, but they still decide to take loans on every home that they buy, it's because it's a smart move. It keeps them liquid, and it has some other advantages too. First of all, it leverages. So in terms of return on investment, you're getting more return on investment than you would otherwise. But one of the other really interesting ones that's very timely, as we have a very high inflation rate right now in our country. And when you have an inflationary environment, a loan is actually a really good tool. So here we go over some of the math on the slide where it talks about how if you have a monthly mortgage of $2,000 and your interest rate is at 5 and the inflation rate is up at 5%, then by year 2, that monthly payment, the $2,000 that you're paying towards your mortgage, is only worth $1,900. And by year 3, it decreases again. By year 5, it's down to 16 something. And by year 30, it's like $450. So every year, as inflation gets worse, your monthly payment essentially gets lower. Your debt gets lower, and it's a really big, powerful tool for it. So those are the 2 big benefits of getting loans that I'd really encourage you guys to consider when you're making your real estate moves. All right, then we go on to the next one. Preston, why don't you go ahead?
Okay. Yeah. So let's talk about the forces at play in today's economy, and then we can focus on what we are seeing within the real estate market itself because of these forces. So like Alex already mentioned, inflation is already rising. We're also seeing the rise of the interest rates in response to that inflation, which we're going to go over here shortly. But before we do that, I do want to just hit the other ones that we're talking about as far as forces go. So the supply shortage in the housing market that has been coupled with the strong demand that we're still seeing as millennials are actually joining the fray when it comes to homeownership. As these millennials do join the fray, they're being met, though, with affordability issues, as home prices in many places have outpaced the incomes of many, and higher interest rates just did not help in that situation. Let's see here. I think we got an impending recession there, but we're going to not talk about that today, so just disregard that for right now. And let's move on to talking about inflation. So take a look at this chart right here, and what it shows is the rate of inflation, which is the red line, versus the interest rates, the green line, from the 1980s through 2022. Note that the gray bars are recessions on this chart. So right now we've got one of those gray bars in there for the 2020 timeframe, right around when COVID hit, and we actually had to see a retraction or a contraction of the U.S. economy due to the impacts of COVID. As you can see at the very end of that chart, inflation is on the rise, that red line again. And today, inflation is currently around 8.5%, meaning everyday expenses have gone up. Historically, inflation had been under 2.5% since 2010, and thus interest rates were able to stay relatively low so that we could stimulate the economy, or continue to stimulate the economy. So this specifically benefited industries that relied on credit or debt to finance long-term expenditures, such as real estate, car sales, construction, and the like. In an effort, though, to show how strong our economy was, the Fed did do some quantitative easing, and as they knew rates were going to have to rise again to eventually combat inflation, because it had been historically low for so long, they just knew it was going to rise. Historically, this has impacted the housing market as home values, conversely rose, meaning buyers had to come up with more money for a conventional down payment, thus delaying the buying decision. These buyers, however, do make excellent renters. So if you did have an investment property, you are going to see that you're going to have more buyers who have better incomes, better stable employment, good credit, and typically they have the money to afford a substantial security deposit just to continue to protect your investment. Alex, is there anything you want to add to that?
Yeah, I mean, I'll say that the common, I don't know if I'd call it a misconception, but the most common idea is people think that it's a very clear relationship. Interest rates go up, home prices must be going down. And it's not exactly that simple. Over the last 40 years, there's been a bunch of cases in which interest rates have gone up and home prices have also gone up. And it's because there's a bunch of other factors. So that's some of the other stuff that we're going to be talking about. So, for now, we'll say, hey, interest rates seem to be going up, and we think it will slow down. Will at least be some downward pressure on home prices, but it's not that simple. So let's talk about supply and demand. That'll be the next one. And supply first. So supply, there's just a critical shortage of supply. There's not enough homes to go around. And it's essentially musical chairs. Any home comes out on the market and there's an average of 5 offers on every single home that's coming out on the market. So that's a lot of supply and a lot of, not enough supply and not enough demand. And the story is pretty much that since 2019, it's gotten worse, right? It went from 3.84 million. That was the shortage of homes. And now it's at 5.24 million, according to realtor.com. And home builders, after the 2008 crisis, that whole industry took a major hit. So there's not enough capacity for home builders to build fast enough. So even though they're trying to speed up, they're getting up to speed, but they're still not able to catch up with this huge shortage. In fact, it seems that it'll be about 10 to 12 years at the current pace before they're able to kind of break even with matching the availability of supply and demand. And what's worse is that pretty much all the new construction that's coming on the market is luxury homes. So that's fine if you're on the luxury end of the spectrum, but for middle and kind of more affordable housing, you've got the inventory you've got, and that's it. So it's going to be extra tight in that same section of the economy. So now let's talk about the demand side of the equation. I'm hearing a little bit of a hiss there. Preston, do you mind if you can go on mute maybe? I'm not sure if it's on your side.
I think it probably is on my side. So
okay. Okay, thanks, man. All right, so now talking about demand. So, okay, now we've got this, there's not enough homes to go around. And then as we go demand, we see that millennials, which are kind of that age group that were born in 1980 to, I don't know when, but when does millennials end? But anyways, most of those millennials who might have took a big delay in forming households after the 2008 bubble, or that kind of crisis, that economic crisis, now those people are starting to come of age. They're kind of, a lot of them are reaching their like early 30s. They're getting married, having kids, and kind of their careers have kind of turned around to the point where now they're able to buy homes. And this happens to be the biggest generation in American history that's now entering the housing market and creating a bunch of extra demand too. So, some of these indicators, these 5 offers per house listed, the average of homes going above list price or days on the market being very, very low. And this is national averages. If you look just in the DC area, all of these indicators are worse, or I guess better, depending on which way you look at it. They're more intense. There's more demand in the DC area than this national average numbers that we're showing here. So there's a lot of demand. Is there anything else that I should add to this, Preston?
No, I think you pretty much hit it there. You talked about the fact that, the average homes, we're seeing a lot of offers on them. You're seeing the sales price go up on them as well. So I think you pretty much hit it there, Alex.
All right. Well then, let's go on to our next part, which is going to be affordability. And this is one of the ones that I really encourage you guys to take away with you, because everyone talks about interest rates. Everyone, supply and demand is kind of, those numbers are, I think, surprising to me, but at the same time, everyone knows supply and demand. Affordability is the one indicator that I don't hear a lot of people talking about. And I believe that this is actually going to be the one that we all need to keep an eye on. So this is one website here, this affordability index that the Association of Realtors has. But essentially what they do is they look at the average income for households, the average mortgage payment for households, depending on the interest rates and the average sales price. So they kind of put all these into a number and it spits out a proportion. And these are kind of the percent of income that an average home is going for the average buyer. And so here, the way that they've defined kind of an acceptable percentage is 25% or less is considered comfortable for a family, and 30% or more is considered burdensome. So as we see from this chart right now, they're still well below 25. Maybe on the West Coast in places like San Francisco or LA, you see homes that are kind of approaching that 25%. You see right now they're at 22.3%. But there's still some room for growth there. And when you start seeing those numbers approaching that 30% mark is probably where I feel that'll be the indicator where people will just stop buying houses because they can't afford it. But right now there still seems to be some room there. So that would be my major takeaway for you guys, is look at affordability and keep an eye on that going forward, because I think that's going to be really the limit. That's going to determine the limit for the buyer out there. So in summary, this is kind of our little chart that we thought, okay, if inflation is an upward pressure on home prices, interest rates, I put that with an asterisk, because there have been many cases in which there is increasing interest rates and home prices still increase. But I think overall it is still a downward pressure. And so we know that interest rates are rising. And for most buyers, they're going to say, oh, well, now I can afford less home than I could before. So we'll give that one a downward pressure. Supply, there's limited supply. So that's pressure upwards. Demand is pressure upwards. And affordability, still there's room for some people to push those prices higher, even by historical kind of context there. So all in all, my prediction is I still think there's room for prices to continue to increase. Maybe not at the drastic rates that we've seen over the last year. I think in the last year it was at like 8%, 18% price appreciation in the US average, which is pretty crazy. But I think that there's still room there. At the end, we'll be happy to share these slides, and there's some links here on some of these articles and some of the resources that we pulled from. But we can open it up to questions if there are any in the group. While people feel free to ask any questions in the chat, what I'll do is I'll also, I'm going to remove this one, and I'm going to just put here in the chat that you can schedule a call with us, just if you wanted to like talk out any specific issues related to your own real estate and your own situation. But let me check the chat and see if there's any questions right now, because we're right about 30 minutes. And yeah, it means a lot to us that you guys tuned in. You know, we don't want to keep anyone longer than they need to be, but yeah, thank you guys. We see some people saying thank you. Affordability, that's a special angle. Good, I'm glad you saw that. And you know, again, just really trying to add value. And thank you guys for tuning in. We'll stay on just a few minutes in case anyone wants to ask. Oh, okay. So here's a question about indicators of a recession. So definitely, I think, you know, indicators, I don't know, because right now, usually when you see interest rates rising, that's a sign of maybe the opposite, right? That's an overheating market. That's a strong market, and inflation is driving that, meaning I guess inflation and a really strong economy are usually tied together. So any predictions of a recession, I think it's more maybe about, what would we say, like, you know, the world economy, right? Things like this war and COVID is still hanging around, and all these things. And to a certain sense, I feel like there's just this feeling that we're due for another recession. But in terms of actual data, I didn't see anything. And that's why we put it in here, because it's in the news. People are talking about it. But we couldn't find much data to kind of really support it. And so, and also because this was more of a macroeconomic kind of thing. And as realtors, I think we're trying to really focus the conversation on real estate and real estate indicators. And so that was another part of the reason why we pulled the recession slide out of there. But yeah, hopefully there isn't one. Honestly, like, we don't want that, and I don't think anyone wants that. But so here's a question: how are you properly helping people? Oh my goodness, what the heck? Okay, so let's not answer that one. Anyone else? All right, guys. Well, here, I'm going to do a quick check here on our attendees. We still got some folks in here in the chat. Yeah, we just want to thank everyone for participating, and, you know, really, we just want to try to add some value. So thanks again. And I think with that, we'll go ahead and call it. Take care, everyone. Goodbye.